All right, so this video is going to be about understanding call and put options. So let's get straight into it. An option is a financial instrument that gives its owner the right, but not the obligation, to purchase or sell an underlying asset at agreed upon date and price. An option is a contract that allows you to gain in the move up or the move down of a stock or any underlying asset without actually risking the amount of money needed to buy the actual asset. Options trade on exchanges just like stocks, and there are options on individual stocks, indexes, commodities, and exchange traded funds. There are weekly option contracts on some of the highly traded stocks and index funds on the market, but only monthly contracts for the lesser traded ones. A couple of index ETFs such as SPY and QQQ have now introduced daily options as well. Every option has a term that is an expiry date. The monthly options expire on the third Friday of each month, while weekly options expire every single Friday. You can buy options for any available future expiry date. So one thing to remember though is that options are time-bound instruments, and trading them without proper knowledge can cause rapid and significant losses. That's basically why I'm putting this video together and a few more videos in the future to give you a proper understanding of options, the different types of options, and factors to be considered while trading options, and how you can manage the risk. So here I put together an example. Say there's a stock right now trading at $170, and you think it's going to go up to $180 and beyond. To actually buy 100 shares of that stock, you would have to spend $17,000. But you could instead buy an option for a strike price above the current price of the stock. The premium of the contract may be, say, $1. So multiplying that by 100, so you're just spending $100 to participate in the entire upswing of the stock from $170 to $180 and make the same amount of gains that you would have made by buying 100 shares of that stock. Your percentage of gains is huge, while you are only risking the premium that you paid if the stock does not go down, does not go in your direction. So there are two basic types of options: call options and put options. There are various bullish and bearish bets you can create by using a combination of these options, but let's start with the basics here. Call options allow you to make a bullish bet on the underlying stock, while put options allow you to make a bearish bet on the underlying stock. Bullish meaning betting for it to go up, and bearish meaning betting on it going down. So technically, a call option is a contract to buy a stock at a specific price. But from the previous example I gave you, the stock trading at $170, and you buy a call option for the $180 strike price for a premium of $1, you pay $100 for one contract, which represents 100 shares. Let us say the option expires on the third Friday of June, which is June 16th, and you are buying the contract today. The option trades just like a stock, and you can sell it for a profit or a loss anytime before its expiry date. If the stock trades above the strike price of $180, say at $185, you are still holding the option at the expiry date, you have the right to buy the stock at $180. If you don't have the sufficient funds, your option will get sold at $5, and you will make a profit of $400 on your original $100 investment. Remember though, if you are trading the stock, you would be buying at $170, investing $17,000. So this really shows the power of call options. So let me illustrate some of the terms that I went over earlier, such as premium, strike price, and dates, to make it more clear and easier to understand. So let us say that the stock is currently at $170, and instead of buying an option for this month, you buy one for October. Then the premium will be way more, since it is a function of time. The further the expiry date, greater the premium. If your stock price is in the money, is above your strike price, then the premium starts to reduce. So in this illustration, Apple is currently at $170. You are buying the October 3rd week expiring option for a strike price of 180, paying a premium of $7.10 per share, one contract being 100 shares, so you pay $710. You can sell this option anytime before expiry for a profit, just like selling a stock. If Apple, say, goes to 180 by July, this option may trade above $15, giving you a 100% profit in less than a month. Once it is above 180, it is considered in the money. When you are buying a call, you are not obligated to buy the stock even though it is in the money. And at any point, your loss cannot be greater than $710 because that's all the money you put in to buy this option contract. So here's what an option chain looks like inside of a brokerage account. This is a straddle view showing both calls and puts for the expiration date of June 16th, 2023. The prices represent the per share premium, and let's say we buy one contract for the 175 strike call option. The ask is $4.55 while the bid is $4.35. So we should be able to buy this option contract for $4.45 per share, meaning $445 because that is the in between that's the middle of the bid and the ask price. Okay, to summarize, taking a long position on calls or buying a call option is basically a bet on the upside for the stock. Your risk is only limited to the premium that you paid, and you can also close this option anytime before its expiry date. You can also open a short call position by selling a call. This is a little bit more complicated scenario, and I will get you into that in a subsequent video in the future. Then at close of trading on the expiration date, if your contract is still in the money and open, you will be assigned, meaning you will buy 100 shares of the underlying stock at your option strike price. And in this case, in the money means that your stock is at least 1 cent above your option strike price. So say your strike price is 180. If your stock is anything above 180, that's basically in the money. So now I'm going to take you guys through put options. A put option is an agreement to sell a stock at a certain price and date. If you exercise a put option, that creates a short position in the underlying asset. So just like with call options, let us take you through an example of a put option. Say for the same stock that is trading at $170, you have a strong feeling that the stock is going to tank. Instead of short selling it, you can buy a put option for a lower strike price, say $165. Let us say you paid a premium of about $1. So that is $100 for the contract, and the stock then subsequently falls to $150. The option will rise from $1 to $15, giving you a profit of $1,400 on your $100 investment. So buying a put option will not force you to take a short position, and the maximum you can lose is the premium that you paid. Put options also give you the right, but not the obligation, to sell a stock at your strike price by a specific time at the option's expiration. So to summarize, taking a long position or buying to open a put option is an instrument to bet on the stock price going down by risking only the premium that you paid, and you can close this option anytime before its expiration. So at close of trading on the expiration date, if your contract is still in the money and open, you will be assigned, meaning you will sell short 100 shares of the underlying stock at your option strike price. And in this case, in the money means that your stock is at least 1 cent below your option strike price. So say your strike price is 180. If your stock price is anything below 180, you are in the money. So here we basically just covered about opening positions by buying a put option, but you can also sell to open a short put position, which is a little bit more complicated topic, and I will cover that in a later video. So another very important function of a put option is to serve as insurance. Say you have a large stock holding and you don't want to sell the stock because it's a long-term holding of yours, but you just want to buy some protection, you can do this by buying put options. Buying put options help you to profit on the downside and thereby hedge your long position in the stock. Say you have a large position of a particular stock, and say the same stock is at $170 and you own 500 shares of it. That current value is $85,000, and there are quarterly results coming up and you think the stock might temporarily go down a lot. You can buy 5 put option contracts for $160 by paying a premium of 50 cents, so that is $50 per contract, or a total of $250 for the 5 contracts to hedge your 500 shares. The results then come out and your stock tanks to $145. You gain $15 on each of your contracts, and that is a profit of $1,500 per contract. Thereby, you have set a floor of $160 on your long stock holding. So this overall put options as insurance is a very good way of protecting a long-term portfolio by covering it for the downside in the short term. If you guys enjoyed this video, please make sure to drop a like on the video and subscribe to the channel. My next upload should be coming in the next couple of days, and I'll see you guys in the next one.